So Matt Piepenburg and myself, we're back for another MAMChat. It's been a while, Matt. And in the meantime, the world certainly doesn't stand still. We have now a world well, first of all, we have the geopolitical problem, which is overhanging the world and is not going to go away quickly. And then I see a summer of discontent approaching, especially in Europe. I mean, there are problems everywhere, mainly due to high inflation, and people wages are not catching up with inflation, of course. So that leads to a lot of protests in basically every European country.
Yeah.
Then, of course, we have the big problem that is going to overhang the world for a long time, which is the currency situation and the de-dollarization. So what do you think is happening there, Matt? And what do we see? What are you seeing?
Well, as the Chinese say, this oft-repeated curse, may you live in interesting times. And to your point, we live in very interesting times. We just went through a charade of a debt ceiling, which we passed over and basically took away. And now, since June 4th, the U.S. is already 700 billion more in debt in a very short period of time. And I think I read recently that the Biden administration basically averages about 500 billion a month in new debt. And so you've got this debt storm cloud ignored hanging over everything. We've got obviously an ongoing geopolitical crisis in the Ukraine. Again, this is not us trying to find circular doom and gloom loops to just confirm a negative view on the world. The facts and the neon flashing signs of this are everywhere. And what's interesting to me, and I want to get your thoughts on right away, is you've got these neon flashing signs of inflation, de-dollarization, which we can talk about more, sticky inflation, a cornered Fed, a debt sick US, which is the holder of the world reserve currency and the most important sovereign bond in the world. And yet, markets saw a hawkish pause, so to speak, by Powell, where he's going to pause for now and raise later. But whether that's true or not, we'll see. But that's a Pavlovian response by the markets, which are, I don't think, climbing a wall of fear. They're climbing a wall of hope. They've priced in that things are all going to be good again. And so the markets see a pause in rates and possibly a pivot at some point. And so they're roaring again in some ways. And as you talked about in recently, the back cafe society is back out with their head in the sand, ignoring all these other obvious indicators. I'd like you to speak a little bit more for us on just this disconnect between the markets and the perception on Main Street or Hauptstrasse or High Street and the real world, Egon.
Yes, and I find that so fascinating, Matt, because we've now had a long period, well, for first COVID and then recovery from COVID. Markets are strong again. People are optimistic. But wherever I go, whether it's in Switzerland, in the UK, and Sweden, where with these three countries I spend a lot of time, there's this disconnect, as you say, Matt, and the disconnect is really between the rich and the poor. You go, in Stockholm or in Zurich or in London, the good restaurants are full. People are spending. And then on the other hand, you have ordinary people who can't make ends meet. They've got mortgage rates have gone from, maybe in many of these countries, have gone from 1% to maybe 4% or even 5%. People can't cope with that. Food costs, fuel costs have gone up by 20% more, even in some places. And I think now most governments are cheating now the way they're measuring inflation. Inflation for ordinary people is a lot higher than the official statistics show. Because as we know, ordinary people, which is most people, spend all their money on the items that have gone up the most. And this is a dangerous situation. And look around Europe, Matt. Look at what around you where you're living, in France. There are, as soon as something happens, police shot a colored person dead, and there are riots everywhere. Okay, justifiable, you could say, but nevertheless, the discontent is always there under the surface. There will be virtually all European countries, there will be some kind of transport strike during the summer, whether that's airlines or trains. That will also paralyze the society because they know where to hit it, where people are all going on holiday. So this is what I'm seeing, and this is what I'm worrying about, because right now the economy looks like it's okay, but that's only for when you look at stock markets and you look at, as I said, the people with money. But not if you look at the general economy, and for them things are getting worse. The virtually all central banks have the 2% inflation target. That didn't manage that on the way up, and when it went up to 10% or around that, they will not manage to get it down. And I think what I see in the energy costs, and also interest rates staying high, the inflation will stay high, and the discontent will continue. So that's and these are what people are ignoring these symptoms. And what do you see, Matt? What do you see happening around your part of the world, and what do you worry about in these areas?
Yeah, very similar things, Egon. I mean, again, you touched upon France and the UK, and I look at the US from afar and from within, heading back there in a few weeks as well to the US. But you've got the Main Street and the Park Avenue crowd, and then you've got the market crowd. Even in the UK, with interest rates rising, I just read recently, and I wrote about it a couple of days ago, that you've got over 1 million citizens that are effectively insolvent because they can't afford their rising mortgage rates. And that's just a simple indicator, but that's not something that the top 10% have to worry about, but the rest of the world does, because inflation is an invisible tax. The purchasing power debasement in the UK and in the US and in France and in Europe hurts the middle class the most, and they have the smallest voice right now, other than collectivizing in big cities when they're emotional and angry about just about any pretext. I think the inflation / recession argument isn't above the mentality of Main Street. They just don't fully understand it. So you can look at it from a Wall Street or macroeconomic perspective. At the macro level, there are just glaring signs that we're heading into a recession at top speed. You've got the Conference Board of Leading Indicators, which has been right for the last 60 years at record high levels of a warning of a recession. You've got the New York Fed, its yield curve analysis. It's got a 70% prediction of a recession. Powell will call it softish. I think it's going to be a very hard one. You've got the PPI index at lowest levels in years. That's a highly recessionary indicator. And you've got credit contraction at the banks, which are under a lot of threat, especially the smaller banks. We had 14,000 of them about 10 years ago. We've got about 5,000 of them right now. Banks, the smaller banks get squeezed out, and the too big to fail banks effectively become branch offices of the Fed. So at the macro level, the signs of recession aren't theoretical. They're not gloom and doom. They're not sensational. They're there. And on the Main Street level, I mean, again, we talked about mortgages in UK, but Airbnb in the US, they're having 50% drops in major cities because there are less and less demand for those properties. There could be a nice big sell-off in distressed assets and Airbnb properties. Even Rolexes on the Park Avenue crowd is a 2-year low in Rolex demand and Rolex pricing. Again, these are small Main Street indicators, and yet you'll hear bullish arguments that new housing construction is at all-time highs. That's interesting, and I think it needs to be looked at more carefully, because what that means is people who already own current homes in the rising rate environment don't want to sell and then have to get a new home at a higher mortgage rate. So the inventory of existing homes is very tight. So the new home construction is only because no one wants to get rid of their properties in a rising rate environment. So there's a lot of stressors on Main Street, and then there's the fancy indicators that Wall Street uses that are screaming recession. And to your point, no one wants to see it, especially at the top 10%. The ignored 90%, which has been ignored since the Fed came into being, and certainly since the 1990s and certainly 2008, they're getting eclipsed. And that resentment is dangerous. That social unrest is dangerous. And then it also comes to the questions of currencies and this inflation, where the dollar is going. And of course, that has to do with the gold price. So I think we should talk about that too, Egon, what your thoughts are on the dollar and the gold price and what's happening this summer right now. What are your thoughts, near term, long term, just on the dollar and gold? Because that's on people's minds too right now.
Yeah, and that's very important. And of course, those are, the dollar and gold, that's the consequences that people don't understand, but there are always consequences of a mismanaged economy and these massive debt levels that we've seen. And of course, the incredible fueling of Europe and America, but with first the general money printing and then the COVID money printing, has led to a very artificial situation. And there's a delayed effect we are not seeing misery generally, but also because maybe we don't go to the areas where there is a lot of misery. But housing prices are going to collapse in most countries. It's a bit of a delay. There always is, but that's going to happen. And commercial property is also going to collapse. That will, of course, lead to continued bank problems in the US and in Europe, major ones. And I see, banks coming under real pressure, and therefore, whatever tightening central banks have attempted in the last few years or a couple of years, that's going to reverse. In my view, there will be massive QE coming. That's inevitable because things are going to be very tough, and the banking world is going to be under tremendous pressure. As we've always said, I think maybe a lot of banks won't survive, but they will only survive, as you mentioned, will only survive at the expense of a collapsing currency. And throughout history, you go back thousands of years, and every time you get to this situation when the world has lived above its means and created money out of nowhere. There's a Swedish economic journalist, very famous one, that I listened to the other day, and he'd recently been to the central bank, the Swedish Riksbank, or the Swedish central bank, and he asked one of the top guys there, I said, "Where do you get the money from?" Like this, he said. Like this.
Voila.
Yeah, and that's exactly what it is. We've been saying that you're creating money out of thin air, and don't expect it will have any value. And once this house of cards collapses, and it's only a question of to what extent it will collapse, and that will be linked to the currency collapse also, then the asset values will implode and debts will implode because nobody will repay the debts. And that's what we're going to see in the coming years. It doesn't happen overnight, and there are pauses. But the dollar, of course, the dollar is doomed. But so is every other currency. And as I always said, it doesn't really matter which one comes first to the bottom, because they're all down, as we've talked about many times. They're all down 98, 99% in the last since 1971. And who cares who wins the last 1%? The last 1% down is, as we know, 100% from here, and that's going to happen. It could be the dollar, but it could also be the euro, and the eurozone is in a mess. You take Sweden here; the currency is dropping all the time. The people who bought gold in Swedish kroner, they're up 12 times this century. And that's just the beginning. Sweden is one of the most indebted countries when it comes to personal debt, not government debt, but personal debt. Every Swede is just indebted up to here. And at 1% or less interest, that was okay, but not at 4 or 5% now. So, as I've always said, Matt, you look at currencies and you look at gold, then all you need to do is to look at history. The trend is so clear. No currency has ever survived in history. Gold has always reflected stable purchasing power, which means it's always held its value against the dropping currencies. And that trend is now going to accelerate in the next few years here. When the currencies will collapse, including the dollar, because the de-dollarization is going to make it worse for the dollar. The dollar is artificially maintaining a high value because of the fact that America forced everyone to trade in dollars. That's stopping now. We're seeing the moves with BRICS, with Shanghai Cooperation Organization, etc. We're going to move away from the dollar, as we've talked about many times. And that will mean that the dollar will fall faster, but all currencies will fall. And we're back to gold, of course. Gold is going to maintain purchasing power value, which it always has. And therefore, relative to accelerating falls in every single currency, gold is now going to become more important than ever. And as I've talked about before, and also in articles, that gold might become also the reserve currency that central banks hold in the future rather than the dollar. And that will make a big difference also to gold and the gold price and the demand for gold. So that's how I see it. It's very simple. Central banks will help as always. If we hold gold, they'll help you by destroying our currencies, whatever country we're in.
Yeah.
And you can't avoid benefiting if you're a long-term investor. Don't buy gold at the high and sell it at the low. Buy when it's coming down. It's coming down now because nobody's interested right now. Nobody's buying, but that's temporary. And buy now if you don't have gold already. Don't wait for it to go up to 2,000.
Yeah.
So that's what I see, Matt. It's going to be absolutely essential to hold a wealth preservation asset in the coming days, or coming years, coming months and years.
For sure. In a lot of ways, we try and keep up with current events, which we do. But the argument we've been making, and you've been making for decades, stays the same. I mean, again, the inevitable future of all fiat currencies is a reversion to its mean, which is effectively zero. The pace of that is accelerating quickly as de-dollarization adds to the tailwind behind an ever weakening fiat global reserve currency. To your point, the BRICS are meeting in South Africa in August. That's include the BRICS plus 19 other countries, including France. It's not the end of the world reserve currency, but it certainly is a changing seismic shift in demand for the dollar. And meanwhile, I think the US government really does want a weaker dollar longer term, to monetize its debt, to get growth in a recession, to inflate away its debt, and finally, even to compete with China like they did in Japan in the 80s. And I wrote about that. They want a weaker dollar to kind of compete with the trade with Japan, which China is clearly beating us in right now. So there's so many reasons, besides just incredibly negligent financial and monetary policy, that the dollar is heading straight down without, of course, hiccups along the way. As Brent Johnson would say, the milkshake theory, there might be peaks for a dollar as a flight to safety, but the trend is clearly weaker and weaker currency, which means stronger and stronger gold. But I'll end with one question for you, Egon, that I think a lot of people have been asking about, and there's been a lot of pundit talk on that. Yes, even for the gold bulls, even for those who really believe in gold, there's this concern, as we saw in 2008, when there is the inevitable market sell-off from this debt bubble and this collision of high rates in a debt-driven equity and stock market or credit market. When that has its mean reversion moment, we see another 08 moment or a March of 2020 moment, and they are forced to pivot to more QE. When that first sell-off in the stock market comes, people say, well, then gold's going to really go down in price. What are your thoughts on that? How do you look at that for gold investors versus speculators as a closing point?
Matt, I'm not the slightest bit worried about that. It's possible that we get a very brief reaction down in gold because that's instant liquidity for the ones who have real gold, and therefore they can offset other losses in markets. But this is 2008. Gold had been in a really strong gold market for a few years, and was temporarily overbought. This is not the situation now. No one is really buying gold. In spite of that, it's drifting up. Temporarily correcting now, but the trend is clearly up. So I don't see any longer lasting correction in gold. And if there was a short-term one, it's just an opportunity. People should not look at gold as a normal investment that you buy and sell at short notice. You just buy your gold, sit on it. Over time, you will do extremely well in a world where money printing is going to accelerate, where deficits are going to accelerate. There'll be more political unrest. And gold is just going to remain the wealth preservation asset that has been for generations. And it is generational wealth. It is not short-term speculative wealth. Right. It's generational wealth. Exactly. And that's really what we are all about. Therefore, there's no reason to worry at all about temporary setbacks in gold. It will happen. Never go straight up, but that will be unsound anyway. Yep. So, Matt, hold on to your gold. I hope the listeners will do the same. We're doing this because we passionately believe that this is the best way to preserve your wealth in what is going to come, which will be very uncertain times. For sure. Well, thanks, Egon. Good to speak again. Well, thank you, Matt. So we'll come back a bit sooner than we have in the past. Now it's been busy times, but anyway, all the best. Thank you very much. Thank you for everybody for listening. Bye bye. Bye bye.